Hi, good evening once again. I want us to look at another topic in financial accounting, revenues and expenditures. Now, it is important that we classify our transactions according to these two types of transactions, revenues and expenditures. The expenditures incurred for conducting a business may be classified into two. We have revenue expenditure and also we have capital expenditure. The first one, revenue expenditure. This is expenditure incurred for making normal business transactions. That means we can buy assets, we can buy items that are for purposes of generating revenue for our business. Like the time when we buy goods for resale. That means we are going to acquire the goods and sell them so that we can actually generate revenue. When we pay for our wages, salaries, rent, all these expenses are for the purposes of revenue generation. This expenditure is deducted from the total income of a trading period for the purposes of determining the profit for that particular period. That means whatever expenses we obtain when we undertake or when we spend on these items, we should be able to deduct from the income that we get during our trading period. We are going to see this when we do the actual comprehensive income statement. Then on the other hand, we have capital expenditure. Capital expenditure here is incurred in the acquisition or purchase of the fixed assets. Remember last time we discussed about fixed assets. Fixed assets are acquired not for resale purposes but for smooth business operations. This expenditure is not deducted from the total income of a trading period for the purposes of determining our profits. Rather, this expenditure is represented in form of fixed assets as you have seen in my previous video, and it is shown in the balance sheet. Now, according to the historical cost principle in accounting, all acquisition of assets are recorded at historical cost. We are also going to determine the aspect of historical and depreciations in our next video. So historical costs are used here to record these assets. Therefore, if we have depreciations here we mean loss of value of that particular asset, and any provisions for depreciation, then we deduct this so that we can be able to obtain the fair or book value of these assets. On the other side, we need to distinguish between capital income and revenue income. So when we obtain income from capital, that means we have proceeds or we have sold non-trading assets. Remember, we said that we can acquire a machine, an equipment, or any long-term assets for purposes of smooth business operations. But there will come a time where we may need to dispose these assets. So when we dispose these assets, we receive income, and this income is referred to as capital income. Then we have revenue income. The revenue income here is derived from sale of trading assets. As I mentioned previously, we incur expenditure on revenue so that we can generate revenues. So the items that we sell, like goods or stocks that we resell, these are items that will generate revenue and they are referred to as revenue income. Then we also have what we call deferred revenue expenditure. Now, this is the expenditure that the benefit of spending now will actually be received in the near future. That means it will not be received in the present, it will be received in the future. An example here, we have advertisement expenditure. When a company advertises for its products or services, they spend now, but the benefits will be accrued. The revenues will be accrued in the near future. It was very important that we understand revenues and expenditures and their classifications under each, so that we are able to know how to treat these items in both the income statement and the balance sheet. Hoping to do more videos. Please stay tuned, and thank you very much for watching.